What if I told you the market has a secret language? Like a hidden tell in a high-stakes poker game? One that could tip you off that a major move is just around the corner. Well, it absolutely does. And today, we're going to learn how to listen in by watching the fascinating relationship between bond yields and the US dollar. Welcome to AI Explains ICT. In this video, we are diving deep into a really powerful concept from ICT's core content, specifically Month 5, Episode 7. We're talking about using 10-year yields to spot some seriously high-probability trades. So here's our game plan for today. First, we'll break down this idea of a crack in correlation. Then, we're going to look at it in the wild with a couple of case studies from 2015 and 2016. And finally, we'll pull it all together and show you how you can use this to get in sync with that big institutional flow.
All right, let's get right into it. First up is this core idea, the crack in correlation. Seriously, think of this as the secret language the market uses to telegraph its next big move.
I mean, just think about that for a second. This is the whole ball game, right? It's not about finding a magic crystal ball, but it is about understanding these deep intermarket relationships that, frankly, most traders are completely blind to. Okay, so in a perfect world, markets have this beautiful symmetry. The best way to think about it is like a seesaw. When one side goes up, the other side is supposed to go down. The classic example is the US dollar index versus 10-year Treasury notes. If the dollar gets stronger, if it goes up, then T-notes should get weaker and head down. It's a simple, mirrored relationship. But here's the million-dollar question. What happens when that relationship just fails? When the seesaw gets stuck, or both sides try to go up at once? That right there is the signal. ICT calls this a crack in correlation, and believe me, it is a massive clue that a big move is being set up by the big players. So, enough with the theory, let's put this to the test. Our first case study is going to take us all the way back to June of 2015, where the market left this really subtle clue that something big was about to happen. Okay, let's break down what we're seeing on the screen. On the left, you've got the 10-year T-note chart. Just notice how it's consistently making new lows all through June, right? Each dip is lower than the last one. Now, if our seesaw rule is working, what should the dollar index on the right be doing? It should be making new highs, but it's not. Look closely. Instead of pushing higher, it's actually making lower highs. That's the crack. The strength that should be there just isn't. And there it is. This is that breakdown in action. T-notes did their part, they went down, but the dollar just refused to rally with them. This little divergence, this failure to confirm the move, that is the crack in correlation we're hunting for. It's the very first hint that a much larger trade is unfolding behind the scenes. Okay, so you might be thinking, well, maybe that was just a one-off fluke. Fair enough. Let's fast forward 1 year to June of 2016. The market gave us another signal proving this is a repeating pattern. Now, here we see the same concept, but it's kind of flipped in reverse. Take a look at the T-note chart on the left. See how the price finds a floor? It's making equal lows. It's basically refusing to go any lower. Now, glance over at the dollar index on the right. It is pushing higher, making higher highs. See the problem? That's another break in symmetry. If that strength in the dollar was legit, those T-notes should be falling, but they're not. They're holding their ground. So the dollar was showing that it wanted to go higher, but the bond market basically said, nope, we're not buying it. This refusal is what ICT calls a qualifying condition. It's telling us that an underlying institutional trade is in play, and that apparent strength in the dollar, it might not be what it seems. All right, now for our third and, honestly, most powerful example. This one didn't just hint at a little move, it signaled the start of a sustained 2-month-long trend. Let's jump to November 2016. Oh, this is a thing of beauty, a picture-perfect example of the signal. Let's start with the dollar index on the right. See that sharp dip? It makes a very clear lower low. Now, in a perfectly symmetrical market, the T-note chart on the left should have responded by making a higher high. But look at what it did. It did the exact opposite. It made a lower high. Folks, this isn't just a crack anymore. This is a massive divergence. It's a huge red flag waving right in front of us. When you see a break in correlation that is this clean, it's basically the market shouting at you that a powerful trend is underway. And that's exactly what happened. The dollar was now coiled and ready for a major rally that would last for the next 2 full months. This wasn't some little short-term blip. This was a quarterly shift in the market. And here it is, the final piece of the puzzle, the fundamental why behind the move. Now, this chart isn't the T-note price. This is the actual interest rate yield. And notice how it just surged higher during that period. This is so critical because global capital, big money, is always chasing better returns or yield. When U.S. bond yields go up, it makes holding the dollar way more attractive. So this surge in yields was the fundamental engine confirming the dollar rally that we saw coming from that divergence.
So this is all really fascinating stuff, right? But how do we actually use this? How do we take all these clues and turn them into a practical trading approach? Well, in this final section, we're going to build a super simple framework for trading with that institutional flow. It really just boils down to 4 clear steps. Step 1, you identify a key market relationship you want to watch, like T-notes versus the dollar. Step 2, you pull up both charts and put them side by side. Step 3, you become a detective and you hunt for that crack in correlation, that SMT divergence where one market fails to confirm the other. And finally, step 4, you use that insight to position yourself for a potential major market shift over the next quarter.
So why does this all matter so much? Because this isn't about trying to scalp a few ticks here and there. This entire technique is designed to get you in sync with the big money, the higher timeframe institutional order flow that really truly drives the market. And you don't have to take my word for it. A direct quote from ICT just sums it up perfectly. He says, this approach puts all of your swing trade, short-term trade, day trade, and scalps in line with institutional order flow. It certainly does put the odds in your favor. It's all about aligning yourself with the current, no matter what kind of trader you are. At the end of the day, the market is always communicating. These relationships between assets like the 10-year note and the dollar are constantly telling a story. The only question is, are you ready to start listening?
Hey, if you found this breakdown valuable, it would mean a lot if you took a second to like this video and subscribe to the channel for more deep dives like this one. And seriously, if you have any questions at all, just drop them in the comments below. A real human will get back to you and help out.
That's all for now. Until next time, good luck out there and safe trading.